You picture it clearly, a quiet apartment building with your own name on the deed, rent checks arriving every single month without fail. 12 units, 12 different tenants, 12 separate streams of income landing quietly in your account while you sleep peacefully through the night. No boss, no daily commute, no endless meetings, just a mailbox full of checks and a spreadsheet that seems to grow on its own. That is the shiny dream real estate gurus sell you on stage, in expensive courses, and in books with smiling landlords on the cover. Here is what almost nobody tells you before you sign that mortgage and quietly become the proud, exhausted owner of a building. Owning an apartment building was never really about simply collecting monthly rent checks from strangers who happen to live under your roof. It was about absorbing risk that insurance companies, banks, and contractors have already priced against you long before you even bought the building. Start with the number every investor throws around so casually: the capitalization rate, the simple ratio of income to the purchase price. In 2026, national average multifamily cap rates sit near 5.6%, having barely moved across 2 entire years. Class A buildings in prime major cities trade around 4.7%, meaning slower returns but far steadier, safer tenants overall. Class C buildings in rougher, tougher neighborhoods can trade near 8 or 9%, higher returns chasing much higher, uglier risk instead. Class B buildings sit somewhere in the middle, trading between 5.5% and 7% depending heavily on the specific local market. Most beginner investors buy Class B or Class C buildings because the entry price looks affordable compared to shiny Class A towers downtown. Take a real 20-unit building generating $342,000 in effective gross rental income annually before any expenses. Subtract $120,000 in yearly operating costs, and you are left with $222,000 in profit. At a 5.5% cap rate, that same building is worth roughly $4 million on paper alone today. That number looks impressive until you remember the mortgage, the insurance, the vacancies, and the one tenant who suddenly stops paying rent. Insurance alone has quietly become the silent killer of apartment building economics in cities across the entire country in recent, painful years. Property insurance is not optional. It is the single expense most new landlords badly underestimate before signing their very first purchase agreement. In Los Angeles County alone, premiums for multifamily buildings rose 50 to 100% between 2022 and 2025. A $12,000 jump in yearly insurance alone can strip nearly $200,000 of value off your building instantly. Nobody warns you that your net worth on paper can vanish overnight simply because an underwriter in another state recalculated your risk. So what is the actual trap hiding underneath the glossy photos of renovated lobbies and granite countertops inside the glossy sales brochure? The trap is that you quietly become a landlord, a plumber, a debt collector, and a lawyer, often within the very same week. A broken water heater at midnight does not care that you bought this building to finally escape a demanding, unpredictable, thankless boss. A tenant who suddenly stops paying rent can take many months to remove, bleeding cash, while lawyers and courts slowly grind forward. Consider Sam Zell, who managed a 15-unit student apartment building in college in exchange for a free room to live in. By graduation, his small management hustle was already netting $150,000, a genuine fortune for any young college student. He did not stop there. He founded Equity Group Investments back in 1968 and began buying distressed properties across the nation. Zell took Equity Residential public in 1993 at an $800 million valuation on the New York Stock Exchange. 2 decades later, that same apartment company was worth more than $30 billion, quietly making Zell a genuine real estate legend. His nickname, the Grave Dancer, came from his habit of reviving buildings that everyone else had already completely written off as hopeless. He was buying properties everyone else feared during downturns, calmly picking up distressed assets while panicked competitors were selling at any price. He was not chasing quick flips or overnight riches. He was quietly assembling a national portfolio, one distressed building at a time. Zell understood something most first-time landlords never fully grasp: that scale, structure, and patience matter more than any single, isolated building. He turned ordinary apartment ownership into a publicly traded machine, distributing 90% of taxable income directly to happy shareholders as dividends. That structure is the real secret behind modern apartment wealth, and it rarely, if ever, belongs to the person who mops the hallway. So who actually gets rich from the apartment building you are dreaming about buying this year with your own hard-earned savings? The bank gets rich first, collecting guaranteed interest on your mortgage whether your units sit completely full or sit totally empty instead. The insurance company gets rich next, quietly raising premiums annually, while assuming almost none of the operational risk that you personally carry. The property management company gets rich collecting 8 to 10% of every dollar of rent, whether or not tenants actually pay. Contractors and vendors get rich billing you at premium rates because they know landlords cannot leave broken pipes unfixed for very long. The city government gets rich through steadily rising property taxes that climb every single year regardless of how your building actually performs. And large institutional owners like Equity Residential get rich because they buy at massive scale, borrow cheaply, and outlast every single downturn. The small independent landlord, meanwhile, often ends up quietly working a second unpaid job just to keep the building barely afloat monthly. This is the quiet architecture of apartment wealth, where fees, interest, and premiums flow upward long before any actual profit reaches you. The building itself was never really about shelter for tenants or freedom for you. It was about who ultimately controls the cash flow. It was about a financial pipeline where everyone holding a contract gets paid first before the actual owner ever sees a single dollar. So should you actually buy an apartment building this year, or is this simply another well-marketed financial trap for hopeful dreamers? The optimist case looks like this. You buy well below market value, self-manage carefully, and local rents rise steadily for years. Cash flow builds slowly, tenants stay long-term, and after a full decade you refinance and pull equity out completely tax-free. The realist case looks far messier. Vacancies happen, one tenant stops paying, insurance jumps again, and your margin shrinks toward almost nothing. You still profit in the end, but slower than the brochure promised, and most early years go toward paying down debt and repairs. The worst case looks like this. A major repair hits right after a rate increase, and negative cash flow slowly drains your savings. You sell at a loss just to escape monthly payments that no longer match the rent the local market will actually bear. Multifamily loan rates in 2026 hover around 5.5% for solid, well-qualified conventional real estate borrowers. That means your mortgage payment alone can quietly consume most of your rental income before a single repair bill even arrives monthly. Vacancy rates nationally sit near 4.8% and are expected to creep even higher through the rest of this year. Rent growth has slowed considerably, meaning the easy appreciation that fueled apartment fortunes in prior decades is simply no longer guaranteed today. This does not mean apartment buildings are worthless investments. It simply means they reward structure, patience, and capital far more than hustle. The people who win long-term are rarely the ones chasing a single building. They are the ones quietly building a portfolio instead. Scale changes everything, because a 100-unit portfolio spreads risk across many tenants instead of concentrating it all in just 12 units. One vacant unit in 100 barely moves your numbers. One vacant unit in 4 can quietly sink your entire month completely. Even property tax appraisers quietly benefit, reassessing buildings upward after every sale, turning your purchase price into next year's higher tax bill. This is why institutional money keeps buying, while individual landlords keep quietly selling and swearing off real estate entirely afterward for good. The math does not lie, even when the dream sounds beautiful on a podcast or inside a glossy real estate seminar room. If you do decide to buy, treat the first building as tuition, not retirement, because early costly mistakes are almost always guaranteed. Study your local vacancy rate, your true insurance trajectory, and your realistic maintenance costs before you ever sign a purchase agreement blindly. Talk to current owners in your target neighborhood, not just brokers who profit the moment your signature finally hits the closing page. Underwrite conservatively, assume higher expenses than advertised, and never assume rent growth alone will bail out a mediocre purchase decision later on. The apartment building was never really about the physical building at all. It was about who actually understood the numbers underneath it. It was about the real difference between someone who owns cash flow and someone who merely owns a monthly headache with plumbing. Real wealth in apartment ownership rarely looks like the glossy photos. It looks like spreadsheets, insurance calls, and patient refinancing decisions instead. The silent millionaires in this space are not the ones posting keys and champagne online. They are the boring, endlessly patient operators. They are the investors who quietly held through downturns, refinanced calmly, and never once needed anyone to know how much they actually owned. They understood something simple, that apartment buildings are not truly passive income. They are active businesses wearing a comfortable passive income costume. That costume is comfortable to sell online, but underneath it sits debt service, tenant management, and constant, unglamorous maintenance decisions every week. This pattern, hidden wealth quietly dressed as simple ownership, repeats across almost every asset class people believe will make them rich quickly. It shows up in vending machines, laundromats, storage units, and franchises, wherever a glossy dream hides a demanding operational reality underneath it. The real money almost never sits where the marketing points, it sits quietly one layer beneath, collected by people who understood the machine. And that is the pattern this channel keeps returning to again and again, the silent, unglamorous truth hiding behind every loud financial dream. If apartment buildings taught you anything today, let it be this simple lesson: look past the dream and study the actual cash flow. Because somewhere behind every rent check you will ever collect, someone else already quietly built the system that profits before you do. That is the real lesson of the silent millionaire. Wealth always prefers patience, structure, and silence over excitement and loud, easy promises. Next time someone promises easy passive income from real estate, remember Sam Zell's early spreadsheet, not his eventual $30 billion empire. The empire came decades later, built slowly on structure, scale, and patience, not on the fantasy of effortless monthly rent checks arriving. Somewhere right now, a quiet operator is refinancing a boring building nobody notices, while someone else buys the flashy one everyone else envies. That quiet operator will very likely still own real estate in 20 years, while the flashy buyer has already sold and moved on. This is not a reason to avoid real estate entirely. It is a reason to approach it with humility, math, and patience instead. The apartment building can absolutely build real wealth, but only for people willing to treat it like a business, not a dream. Every number in this video came from real market data, real transactions, and real people who actually built lasting apartment fortunes over decades. Sam Zell started with just 15 units and a free room, and built one of the largest apartment empires in all of American history. You do not need his exact scale to benefit from his lesson. Structure and patience beat excitement in nearly every real estate cycle. The next time someone shows you a beautiful apartment building online, ask who actually profits first before you ever ask about the rent. Ask about insurance trajectories, vacancy assumptions, and true maintenance costs before you ask about granite countertops or freshly renovated hardwood flooring inside. The silent millionaires already asked those boring, unglamorous questions years ago, quietly, without an audience, long before they ever became wealthy from property. That is exactly why they are wealthy, and why so many louder, more excited buyers are still chasing their very first profitable year. None of this requires genius, it simply requires patience, honest math, and the discipline to keep operating quietly after everyone else has stopped. Most people quit real estate not because the numbers failed them, but because the boredom of ownership never matched the excitement of the dream. Wealth built on real estate consistently rewards patience over passion, structure over storytelling, and boring spreadsheets over beautiful renovated hallway photographs online. The dream of the apartment building is not entirely fake. It is simply incomplete, missing every hidden cost hiding quietly beneath its surface. Fill in those missing costs honestly, and the dream slowly becomes a real, achievable business instead of an expensive, disappointing financial lesson. Every silent fortune in real estate was built the same quiet way: one accurate spreadsheet, one honest number, one patient decision at a time. Apartment buildings, storage units, laundromats, and franchises, the packaging always changes, but the underlying architecture of who profits first stays remarkably identical. Understand that hidden architecture once, and you will start seeing it everywhere else that money quietly moves, far beyond real estate itself. That is the real education hiding inside every apartment building story, far more valuable than any single property you could ever buy. Because once you finally see who profits first, you can decide, with clear eyes wide open, whether you truly want to play this game. And if you do choose to play it exactly like Sam Zell, with patience, structure, and total contempt for the easy dream. The silent millionaire is never the loudest voice in the room. They are simply the last quiet person still standing after the cycle turns. Subscribe if you want more stories exactly like this one, where we quietly take apart the loud dreams that everyone else keeps selling. Because the real money was never inside the building everyone loves to photograph, it was always hiding quietly in the numbers nobody wants to discuss. And that pattern, hidden in plain sight the entire time, is exactly where this channel will keep looking for the very next silent fortune.